All right, so if you look at how retirement has changed over the last couple of years, there's been a significant change. We've all talked about the age of the pension and how that's kind of gone away. Well, when pensions were king, people retired at about 62. They got their Social Security, they triggered their pension, they had their savings, bing, 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 three-legged stool, we're on our way, easy, simple. Well, the pensions went away. That knocked out that part of the stool. Social Security says that they're going to cut back that part, that cut another leg off the stool. This is not good. And what's happening right now is the retirement age has moved up to 65. We are having to plan and save another couple of years to make up for the fact that we don't have pensions anymore. Well, Charisse, I wanted to ask this. If somebody came in at 62 thinking that they're going to have to work to 65, are there times when you sit down and say, you know what? You've got the income. All we have to do is have some income planning here, and you can retire. You think you can't, but you can.
Pensions are certainly a dying breed. And in 1978, when they created that 401k, those pension managers and these companies did not want the liability of making sure you got income in the future. So they created this beautiful 401k, and you saved and it worked. And a lot of people have a lot of money in those buckets, but now you are your own pension manager, and life after the 401k totally changes, and people spend less money and they retire later because they don't know what to do. They don't want to run out of money. They don't know how to take income checks, and they retire later than 62, Randy, is because they get Social Security at 62. They know if they wait to retire to 65, they're going to get more. But when you don't have a secondary paycheck coming in to cover maybe some of your fixed bills and some other things, it is an absolute psychological and emotional hesitation that people have. And what I have learned that most advisors are not coaching is that if you have a income plan, a well-written income plan, most people don't have income plans like we have here. People will retire at 62. They won't wait till 65 because they also wait till 65 for insurance. And we let them know, hey, you don't have to wait because you have enough money for insurance and it doesn't erode your long-term investment plan, right? And so until people come in, we can build a pension, right? You're going to get Social Security. If you want that pension and you said, hey, Charisse, I got $1 million and I do want a pension. I don't want all of my money in a pension. Can you create that strategy for me? We can absolutely do that. I never recommend all your money into that bucket because you're going to want liquidity and you're going to want to make sure a legacy is growing and you want long-term care coverage in case you need it in the future. So we want to be very diversified in our choices. But I will tell you, when you have a pension income, it gives you the okay to spend more money because it's always going to show up and it's never, ever going to go away. So it makes people feel comfortable that they can just keep spending. And those people who do have those pension checks coupled with Social Security, they still pull money out of their lump sum, but they don't pull as much because they don't need as much. Therefore, they're still spending more money than the average person who comes in with just a Social Security check and a 401k until they sit with us and we build that out for them. So I tell people, don't be afraid to come in and see what that's about. Don't be afraid of the conversation. Don't keep waiting because you're buying income. When you purchase a pension plan with us, and it takes a little time to grow. It could take 2 years, it could take 3 years, it could take 5 years, but it's growing at a guaranteed rate on your pension income side, which is really valuable to you. If you wait and come in 5 years and then we start it, then you probably have to wait a couple more years to take it. So we want you to take it when you want to take it so that you feel that comfort level of spending that money earlier than later. So that's why it's just really important to plan ahead before you retire, that 5-year mark before retirement. But if you are retired, you can still build that in. You just might want to hold off a little bit so it can grow, in my opinion.
Well, 401ks have been a great savings vehicle for us, but they don't do anything for you when it comes to income. When you get to retirement, your 401k doesn't automatically pay you like a pension. That is up to you. That is where Charisse comes in, said, you've done a great job saving. Look at this nest egg. Let's build income out of it. What does it give you as a paycheck? And then combine that with Social Security. That's what retirement planning is. Give Charisse a call. Let's go through that process. Maybe you are heavy 401k, which is great. But what does it do for you in retirement? Let's figure it out. 833-368-3680. Again, 833-368-3680. Or use the website, which is zinniawealth.com, ZINNIA wealth.com. Click on that gold box. Well, I looked at this headline, Charisse. It says millions of Americans spend decades saving for a retirement only to trip over tax bills at the finish line. So it talked about the three different kinds of money that we bring into retirement. There's the pre-taxed stuff. That's your 401ks and your IRAs. You've never paid taxes on that money. Then there's the after-tax or tax-free money. If you have a Roth, you've already paid taxes on that. That's tax-free in retirement. And then the taxable accounts. So pre-taxed, after-taxed, and taxable. We got all that going on at the same time.
Yes.
So I'm thinking like a pie here, Charisse. Should my pie be 1/3, 1/3, 1/3, or how do we mix this up? Does there come to a point when I've been plowing money into a 401k and you look at me and you say, no more? We got to have a different kind of money. How do you deal with this?
So we teach this in our workshops. It's a very heavy tax conversation. And there's three buckets. Think of it as the pink bucket. That pink bucket is your 401k, your IRA, all the tax deferred dollars you never paid taxes on that you saved with the employer, right? So that's the pink bucket. And then we have a yellow bucket. That's your brokerage account bucket. That is, let's say you buy some stocks because you just sold a house. You're like, Charisse, I have $100,000 and I want to buy some stuff. So you put it in this yellow bucket, the brokerage account bucket. That's the taxable bucket. So that's different than the pink bucket, which is the tax deferred because that was your 401k and IRA. The yellow bucket is your brokerage account bucket. And we have to be careful what we buy in there, right? Because there could be dividend stocks and you have to pay taxes on it every year, and or you can just do growth stocks where you don't pay taxes till you sell. So the question is, should we have more in the pink bucket or the yellow bucket? And then there's the third bucket you're talking about. That's the tax-free bucket. I call that my black bucket. It is my favorite bucket. And by the way, my favorite color is black, but I wear lots of bright colors these days. So remember that. Favorite colors are black, and the black bucket's my favorite because those are tax-free dollars. My goal is to move you from the pink bucket, that tax-deferred 401k IRA, over to the black bucket, my favorite bucket, because all those dollars, as long as you've had it for 5 years and you're 59 and a half and older, it's all tax free. And so why is that so important? Because over time, over the next 30 years in retirement, you are forced by law to pull a higher percentage out of those IRAs every year, that pink bucket, which is going to cost you a whole lot more in taxes over 30 years in retirement. What if you were to roll that pink bucket money over to the black bucket money over the next 10 years and you only pay taxes for 10 years and you live 30 years? And then later on, taxes go up. You're like, wow, that was the best strategy in the whole world, right? But to move money from the pink bucket to that black bucket, so that tax deferred bucket to the tax free bucket, you got to pay taxes that year. And I'm going to show you how to do that. But let me go back to my yellow bucket. That's the in-between bucket. Because your question, Randy, was how much should you have in each bucket? Well, when most people retire, if you have $1 million, you have approximately $800,000 in the pink bucket. And you have approximately, I would say, an average of 100,000 in the yellow bucket, the brokerage account bucket. And then you typically have, maybe if you're lucky, 100,000 in the black bucket, the Roth bucket, because the 401k is where you shove all your money your entire life. So what we want to do is, if I had a choice, I would move 100% from your pink bucket to your black bucket, and we'd have no more pink bucket.
Gotcha.
That's your tax deferred 401ks, and move it to the Roth IRA. But a lot of times, some people just there's other things they need. So once in a while, we'll move it from the pink bucket to the yellow bucket, right? That's the taxable bucket. It depends on quite a few things. So we always want to have a little bit of that yellow bucket because we can do tax loss harvesting on that bucket to give you income in the short run, as long as the timing works out without having to pay taxes. So tax loss harvesting, most advisors don't do it. Your CPAs will charge you a fee to do it and we'll do it for free. So again, it's a little confusing, but just remember pink bucket, yellow bucket, black bucket. Charisse Reese wants your money in the black bucket. And not everybody should do that, by the way, because when we do the math, sometimes the math says otherwise. So let us do the math. And at least moving forward. And you can move money from that pink bucket to the black bucket anytime you want, by the way.
Yeah, we've said this a couple of times today that your retirement plan will be different than anybody else. If someone comes in and they've got a nice pension and Social Security, their income needs might not be that much, but their tax needs might be something big. And then you might be completely the opposite. You've got all sorts of 401k money, but no pension and Social Security. Now you have an income problem, and we have to move things over to that black bucket that Charisse is talking about. Everybody's going to be different. Let's figure out what you need in retirement. Is it income? Is it tax planning? Is it all of the above and all the different things that we talk about here on the show? Give Charisse a call. Let's figure out what the needs are, and let's start moving the plan forward. Start doing the math on your retirement. 833-368-3680, 833-368-3680, or use the website, pretty easy, zinniawealth.com, ZINNIA wealth.com, and hit the gold box. You'll be on your way. If you hire a financial advisor, you probably think, well, I'm going to hire this person and they're going to show me exotic investments that nobody else knows about, and it's going to make me a rich person. Okay, yeah, I get that. All right. But there are a lot of people that think that you don't have to do that. Boring is better. The people at Vanguard, they follow Jack Bogle. They call themselves Bogleheads, and they came out with an article that says all you need is these three things. Three things only: a U.S. stock market index fund, an international stock market index fund, and a U.S. bond indexed fund. That's not very exotic, and that's kind of boring, actually. But do you think somebody could run their retirement with just three funds like that? How many do you have to have?
Well, I think you need more than three funds.
Okay.
I truly believe that.
All right.
Because if you have the U.S. stock market fund, that might be more like the S&P 500, right?
Follows the index, right? Yeah.
Follows the index, right? And everything goes up. Well, that's great. If you have a half your money in there and the market goes up 30%, then yeah, you're probably going to get your 30%. But then if the stock market goes down 30%, you're also going to lose 30%. So is it better to make the 30% and also potentially lose the 30%, possibly 40%? Or is it better to make maybe 15% and mitigate the downside risk to 5% or 7%? And it's all perspective, Randy. It just depends on the age and season of life you're in, what you've experienced, what you want your money to do, and what you don't want to see your money do, right? And so, for example, we have some clients that come in and say, Charisse, I don't want to lose a dime. Well, you're not going in that portfolio. We have some people, and I just sat with one of them, who says, I can handle all that risk. Give me more, right? And so everybody's going to be a little bit different, and we have to be able to cater to both. So even in that S&P 500 fund, you can invest in three strategies, for example, in the S&P 500 fund. One that takes no losses, one that takes 100% losses, and one that takes half the losses, which is really incredible. Most people are like, what is she talking about? Well, that is exactly what we do in our office to split up the diversity inside that risk bucket at the same time, depending on the season of life you're in. And most clients want all three of those buckets. Same thing with the international fund and the bond fund. Like, I don't believe in just a bond fund. When you say, hey, I'm going to get this bond fund, for example, let's call it the aggregate bond fund at Vanguard, all corporate bonds, and interest rates start shifting gears, well, guess what? Vanguard ain't moving those bonds fast enough to protect you, so those bonds are losing money, right? What if you had an active bond fund that has bond funds among bond funds inside of them, so they're not overlapping and doing the same thing, and they can manage the interest rate environment, because when interest rates go up, bond values go down, and vice versa. It's a teeter-totter. When interest rates go down, bond values go up. So there should be a triggering mechanism inside your portfolio that says, oh, I have this aggregate bond fund, maybe all corporate bonds. Hey, interest rates are going up. Uh-oh, my bond's about to go down. And so most humans aren't going to make a change. but an algorithm will if you have it built in, and or you have a human element that does active trading inside of a portfolio. So we just want to be not creative. We're not reinventing the wheel, but we want, you know what people want, Randy? They just want to know somebody's thinking through this stuff as this stuff is changing, because they want to be in Tahiti drinking their Mai Tais. They want to go on the cruise ships with their spouses. They want to go camping with their grandkids. They don't want to worry about this. This is my job. This is my time to shine and impress the people that are trusting us most. And it's their time to not give a care and make sure they don't run out of money and all their accounts just lose 50%. And now they're just like, okay, well, we got to cancel that trip and this trip and that trip, right? And that's what people want. So I don't like getting all complex on radio about the different portfolios. But no, you shouldn't just have a U.S. fund. You shouldn't just have an international fund. And no, you shouldn't just have a bond fund. I call this the dumb fund. That's the dumb plan. And so I know some people are like, oh, that's a little rude. Yes, it is rude because I've seen it just not work. I've also seen it work. But does it work when you start living on your retirement dollars? And the answer is, if the market's going down, no. If interest rates are going up, no. If anything could be happening, right? And there's a lot of noise out there today. So, we're not trying to seek a 50% return, right? I just had a review with a client. We made 47% one of his accounts. His other account did 25. The other account did 15. The other one did 8. And I said, are you so okay with this strategy? He went, absolutely. Because when the market crashes, he's like, that 8% account ain't going to go down 50%. He's like, I have peace of mind knowing that, Charisse. And so it's bobbing and weaving, and not all of our money has to be making those double-digit returns, because it's not what you make, it's what you keep.
I love what you said there about the 3 things you should be worried about are maybe Hawaii, Alaska, and Cancun, not index funds and bond funds and international funds. Let's get our priorities straight. That is why you would bring all of this to Charisse and let her worry about that part. You worry about having fun and having a great time in your retirement. Give Charisse a call. Let's sit down and do the math on your retirement. It's a no-cost, no-obligation look at what you've done, what you want to do, put it all together. Are there any gaps? Do we have to fill any of those gaps? Are you worried about Social Security cutting back? Are you worried about health care? Let's get all those worries out on the table. Here's the number, 833-368-3680, 833-368-3680, or ZinniaWealth.com, ZINNIA Wealth.com. Hit that gold box that says complimentary retirement consultation. All right, the rule of thirds. This is a new one on me, Charisse. This is how we should parcel up our money. 1/3 in guaranteed income. That's your Social Security, pensions, and annuities, things like that. 1/3 in fixed income investments. That would be bonds, CDs, and treasuries. And 1/3 in equities. That's stock market, ETFs, and mutual funds. So just parceling things up. Is there a percentage that you would have in each of these buckets, or is this crazy, Charisse? Is this just another clickbait? Is this good stuff? What are we saying here?
Is it clickbait? I mean, yeah, it's actually really good clickbait.
Because I clicked on it, yeah.
You clicked on it. So you can follow the rule of a third. I think you can get yourself in a little trouble there. What I do like about the third rule is the first rule in the 1/3 rule. And the first rule is you have your Social Security with your pensions. You don't have pensions. What you do, you sprinkle into an income annuity that's guaranteed for life, so that the 30-year money that you have coming in pays your bills, always and forever, even if somebody passes away. So making sure that your fixed expenses are totally covered. I like that third. But some people need more than a third of their assets to cover the fix. So now you're really looking at 50-50, because if you got a smaller Social Security, no pension, then you got to put more money into this annuity to cover that fixed bill environment for the rest of your life. Then you only have 50 left over. So I want to squash the strategy, but I want you to understand the thinking is valid. I don't like having a third of our money. This says a third of our money in fixed instruments like treasuries, bonds, and CDs, because people take that to the next level. And all of a sudden, if you got $1 million, you're like, I'm going to go put 300,000 in CDs. No, we don't want to do that. Or I'm going to put 300,000 in money markets. No, we don't do that. Or 300,000 in treasuries. No, we don't want to do that. But we do want to think through it and maybe sprinkle a few dollars in each one of those investments and really decide how that bond portfolio's outlay is going to look, and then sprinkle in some other strategies. I call them safe money strategies. That could be even more icing on the cake, let's put it that way, to your investment portfolio. The other third is the stocks, mutual funds, and equities. Well, number one, we do not like mutual funds, and you shouldn't either. But until you sit with me in my office, you won't know why. But we do like stocks and dividend stocks, and we do like exchange traded funds. But I think the first question we got to ask is, do you really put a third of your money into the stock market? And you're 65 years old, or between 65 and 75 years old, that's the part you really got to think through. Like, do you really want to risk a third of your money? Mm-hmm. How much of that third do you need? And is it really half of your money you're risking, right? So that's a question you have to ask yourself. So remember, we used to talk about the 20, 30, 20, the 40, 30, 20, 10 strategy. Mm-hmm. To me, that would be, we should call it the 1/4 strategy, right? Maybe 40% of your money definitely buttoned up safe, 20% at risk, 30% somewhere in the middle, and the other 10% is part of your income and liquidity phase that you need for the next couple of years. So it needs to be more strategic than that. But if you're going alone and you understand what this means, and yeah, it's not a bad rule to follow. But if you're trying to dial in, leave more of a legacy, make sure there's a long-term care plan built in, make sure that, there's assets there for when you pass away for the surviving spouse. You probably need to delve in just a little bit more, build that income plan to make sure that does make sense, because I have not met too many of my clients where actually that would make sense. I would say a few probably certainly will. But I think what the moral of the story is, the guaranteed income is like, it's absolute certainty. It's going to be there. The other third is the fixed income, the safer stuff. Hey, this is our money that we're going to be living on most likely for the next 5 to 7 years. And then the third portion of our money is like, okay, how much can we lose and emotionally handle to lose over the next 10 years if we don't need to touch it? So I'm okay with a third of your money in the stock market if you promise that when it goes down and crashes and burns, could be next year, it could be 3 years, it could be 10 years now, wherever it is, that you're mitts off, you're not going to sell it at the bottom. Therefore, you're also not going to need it when it hits the bottom because you have your other buckets full. So you really got to think through it. So.
Well, we talk about the three aspects of retirement planning, and every retirement plan has to have preservation, income, and growth. Now that spells pig, so it's not a great marketing campaign, but
does it? Oh, I like it. How can we turn that?
The pig problem, yeah. But actually, these three kind of go along with that. The guaranteed income is your preservation, your income, and then the third in equities is your growth. Mm-hmm. So there is some truth here, and there you can start maybe use that, as we say many times, as a guideline, as a starting point, and say how much of my income do I need here to make up what I need. And that's a conversation for you and Charisse. And when we talk about doing the math on your retirement, this is exactly what we're talking about right here. How much do you need per month for essentials? How much do you need for fun? Let's figure that out. And that is what it is to sit down with Charisse. Give us a call. Give the team a call. Let's get a date on the calendar and go through it. What have you done? What have you saved? Where is it? How's it doing? And what do you want to do? Let's put this all together, kind of put it into the salad bowl and see what comes out. And many times there is something there that you hadn't thought of. Might be a tax problem. Might be a healthcare thing. Maybe you don't have anything in the wills and the trusts and the legal documents. That's a part of this too. Let's get it all taken care of. 833-368-3680. 833-368-3680 or online, ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box that says complimentary retirement consultation. Click on that. You'll be on your way. Charisse, that is all the time that we have on this one. I will give you the last word.
Well, as usual, live by design and not by default. And we'll see you here next week.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.